Good afternoon, everyone. This is Colonel Todd Domachowski here. Sorry, I apologize. This is a re-record. I forgot to hit record when I gave this live. There were money questions, so really don't have to cover too much, but I'll hit on those questions that did pop up. But we're here, part 5. We're going to talk about mutual funds and other retirement options. This builds on yesterday's discussion about TSP. It builds on really all of them, and we'll get to that, how they're all kind of related. But we're going to talk about mutual funds and other retirement options today. You've seen this warning. This has been every single briefing I've given. This is not a get-rich-quick scheme. I will not make you rich by knowing this information, but I hope to make you educated. The goal of all this Financial Literacy Week has been to gain wealth, the wealth of knowledge. And I do ask you to pay it forward the best you can. Get more people on that Teams page. Send these briefings everywhere so that people have the knowledge and know what questions to ask to make sure they're better prepared for their financial future. We did talk about this pretty in depth last time about, let me check 1 second to make sure we're all good to go and online here. So I do apologize, just making sure we're good. I know you all can see what I'm doing. Looks like we're all good. Just wanted to double check before. We talked about this yesterday in the TSP risk. I'm not going to hit it super hard because if you watch the TSP, you'll get all of that. But all investments do carry risk. When I talk and say investments, I'm not really referring to your savings account in your local bank or your certificate of deposit in your local bank or even your savings bonds. I'm really talking about the stock market. Investments are stock, bonds, mutual funds, these things that are in the stock market. And remember the mood of the market we talked about. It's very difficult to predict and time the market. Sometimes a company does something wrong, the market goes down. Their particular stocks go down. Sometimes we get into a conflict in a operation or war that the stock market goes down. A panic may happen. A run on the banks can all create this mood of the market that you just can't always control. That's an investment risk. I'll give you a little example of an investment risk, a mood of the market. I was investing in a company. It was HP. So this is a while ago. So I had some stocks in HP. After hours, a memo was released by HP headquarters saying they're going to have to severely reduce and cut back on items, meaning they're losing money. If you think the stock market stops when the bell rings and they're done for the day, absolutely not. Stocks continue to move after hours. When I couldn't stop, I couldn't get out of it until the next morning. I ended up losing a bunch of money. Mood of the market. It was just a memo that got released after hours. Boom, the mood of the market. Bad timing. Sometimes there's bad timing. I used an example in the TSP briefing about just a few weeks ago. Someone in a congressional briefing said, the Dow's at 50,000. Well, cool, but now the Dow is at 46 and change. So if you invested when the Dow was 5,000, the market has gone down since then. Just bad timing. And those who can time the market, that's more of insider trading, very difficult. Sometimes you're lucky, sometimes you're not. And just a reminder though, as we talk about mutual funds and investments, they're not insured. So FDIC or NCUA insured, they are not. Like your savings accounts are, mutual funds are not. However, if your brokerage firm goes belly up or fails, you do have some insurance through the SIPC program up to $500,000. Another one is business risk, meaning the business just makes bad decisions and it falls apart, goes bankrupt. That is the risk that you take when you put money into an investment. It may go belly up or maybe the next Amazon. You just don't know. It's a decision you make when at the time with information you have, you believe it's the best route for your dollars. It could turn out yay, it could turn out nay. It all depends. That's risk. But why and why risk? Why do we talk about risk? It's the risk versus reward. Banks are safe. Banks are paying you 2, 3, 4%, hopefully in the 3 to 4% range. If not, please go listen to Basic Savings. and watch and listen about where you can get higher interest rates. But banks are safe. They're insured, right? The markets are risky. You put $1,000 in today, it could grow, it could go down, but you have a chance to lose your money. But where the stock market comes into play is, on average, it beats inflation versus when you're not keeping pace with inflation. Risk could equal losing your money. Just remember that. But also on the other side, you may do well. This is what this is all about. Education, so you understand the risks involved, so you can make better financial decisions in the future. Before we talk about what a mutual fund is, what's a mutual fund? Well, we're going to have to go back in time and work on some terminology and definitions. We're going back to 101. Welcome, I am Professor Todd. No, just joking. Stocks. Definition of stocks, basically, they are a ownership or a equity position in a corporation. So if you own a share of Amazon, you own part of Amazon. You have voting rights associated with that one share of stock. One share of stock is not going to do much voting wise, but if you've ever watched movies and they talk about this person owns 51% of the company, so they control the company, or the hostile takeovers where they go out and buy all these shares of stock to take control of that company. Stocks, it's the riskiest because if that company goes bankrupt, there's nothing left. Your stock's worth nothing. There are two types of stocks you need to understand about: growth and value. Growth is about growth. What they do is they take all profits, reinvest it back into the company so it can grow as fast as it can and make the most money. And again, reinvest back. It's always growing and reinvesting. Value, on the other hand, is still growth. However, they distribute profits to the owners through dividends. So for example, if you own General Electric, was always great at giving dividends. If you own General Electric and you hold a share of stock, they will give you annual dividends. So they give you money. Most people take that money and reinvest it back in. So really it's an automatic. Instead of them giving you money, they just buy more stock, so you own more of the company. That's value. They focus on growth, yes, but they also distribute dividends to make the owners happy. So they don't grow, so they're not going to have as high of a rate of return because they are not reinvesting their profits back in. They're giving some of the profits out. It's good to understand the two, because if you're looking for dividends, so you grow more, meaning you grow more of your ownership, you keep on having more shares and more shares and more shares, value's the way. If you're not worried about that, growth, and I'll talk about more of that later, how you make money with a mutual fund. Bonds. Bond is a debt instrument. It's a conservative investment. Basically, you are loaning this company or government money. So how a bond would work is, for say $1,000, you loan or buy a bond from a company as a 30-year coupon or 30-year term. And the coupon rate is, we'll say 4%. That's how much interest they're going to pay you each year. So every year they're going to give you 4% back on your bond. And at the end of 30 years, they're going to give you your $1,000 back. So it's a loan. You are loaning money to this company. Where bonds and stocks differ is you are now a debtor to the company. They owe you money. So if that company goes bankrupt and they still have something of value, like they have to sell the building, they can sell the building, you get in line as a debtor. So they owe you money. You may not get all your money back, you may get nothing back, but you can get in line and say, hey, I loaned this company money, I want my money back. Not a guarantee, but that's one of the big differences why it's a little less risky to do bonds, because you are a debtor and you can get in line and request money if they happen to go bankrupt. Cash and cash equivalents, just like they sound, it's cash or cash equivalents, like a CD, a savings bond, cash. One thing about stocks and bonds we need to understand is, in the stock market, we've all heard of the stock market, and we talked about the indices, the indexes like the S&P 500, the Dow Jones, and all those things yesterday a little bit. We'll talk a little more on them as well. But understanding stocks can be traded throughout the day and after hours. Bonds do the same thing, but just not as much. Stocks move a lot depending on the company. Bonds don't move as much. It's a little slower pace. With mutual funds, you got to understand, they only trade once a day. at the end of the day. And I'm going to explain that more on what a mutual fund is and why that happens on the next slide. Definition of a mutual fund is a picture. That's all I gave you. But I'll explain this picture. A mutual fund. You start with investors like you. You give a bunch of money or some money, a little money. You pool their money. A lot of investors get together and you pool your money. You give it to a fund manager. That fund manager takes all that money, because now they have a large sum of money, and they invest it. They make a portfolio. It could be stocks, could be bonds, could be a combination of both. And they manage that money and try to make you money. And they give you in the form of returns, and they pass it back to you as an investor. It could be dividends, just could be because now it's worth more, you sell it and you make money from that perspective. What mutual funds do, which is really great, is it gives you the ability as an investor to buy something you could not buy. A mutual fund gives you a pool of resources and access to investments that you could not do by yourself. Just like TSP, and we talked about how the C fund was S&P 500, 500 largest companies. By buying C fund in TSP, you are buying the whole market, the S&P 500. And that's like a mutual fund. Your $1 invested in a mutual fund is buying more than you could with $1 in the stock market. If you buy one share of Apple, cool. With that $1 in this mutual fund, you could be buying Apple, Walmart, Intel, Caterpillar, DuPont, for example. You'd be buying all these companies with that $1 that you could not do on your own if you're doing it separately in the stock market. That's the great thing about mutual funds, is it spreads your money out to work on one asset allocation below. You're going into different asset classes, stocks, bonds, cash equivalents, different types of stock growth, international, global, emerging markets, precious metals. There's a mutual fund out there for anyone. But the most important thing, and why I like to talk about diversification and mutual funds, is, as I just said, diversification. You're not putting all your eggs in one basket. That whole, we've heard that before. Don't put all your eggs in one basket. That $1 you have is at risk. However, it's spread out among multiple companies to reduce your risk. So let's talk about $100 investment. You have $100. Your grandma gives you $100. Like, I'm going to go invest in the stock market. Cool. You go buy a share of Apple. Well, you can only buy probably a partial share of Apple, because I believe Apple sells for more than $100. So you buy that. Cool. You have Apple and Apple only. But you take that $100 and you put it into a mutual fund. No, I will talk about minimal balances. Most of the time, you can't open a mutual fund with $100. I'll talk about that a little bit later. But the principle is $100 in Apple, $100 in the mutual fund. But in the mutual fund, you own Apple, Intel, Microsoft, Google, Caterpillar. So if Apple's having a bad day, Apple, your stock, one stock or share of stock is going down. So your money is at risk now. However, in that mutual fund, Apple's only one of 7, one of 8, one of 10, one of 100. It's not going to really cause that much of a ripple with your $100. It may go down, but the other companies may be having a good day, so they keep bringing it up. So the same $100 investment, one in Apple, one in a mutual fund that holds Apple, you actually might make money that day, because all the other companies could bring up Apple, or vice versa. They could have a worse day than Apple. That's risk. But mutual funds diversify your risk by not putting all your eggs in one basket and allowing you to take that $100 and spread it out amongst multiple companies that otherwise you could not do by yourself. And that's the greatness of mutual funds. Asset allocation and diversification. You can get into things across the board that otherwise you could not do with the same money. How you make money with mutual funds, and this is also similar with stocks. Bonds pay you interest payments every year. if you own an individual bond. But if you happen to buy a bond through the stock market, which you can, the bond market, not the stock market, the bond market, you could sell it for a premium or a loss as well. Always want to sell for a premium to make more money. But how to make money in general with a mutual fund: dividends and increase in share price. This is the only two ways. So dividends, also including capital gains. A capital gain or capital loss is when a fund manager who's managing your mutual fund buys or sells stocks, bonds within itself. If they sell them for a positive, you have made a capital gain. If they sell it for a negative, you have a capital loss. And they're doing this all the time. So you have a bunch of capital losses, you have capital gains. Hopefully by the end you have more money, so you actually have a capital gain. That is like a dividend. They give that to you in the form of like a dividend payment. And then dividends, which is basically them sharing their profits with you, is a dividend. Again, most people will select when they have their investment that they reinvest all dividends back into the mutual fund. That is a normal thing to do. The other two is increase in share price. If you buy it for $10 today, and in 30 years from now you sell it for $100, you have made $90. Right? That's increase in share price, pretty easy. Understanding taxes, though, is one thing. I want to make sure you understand taxes. Going back to our tax one, is if you keep your investment for more than a year, you have a long-term capital gain taxed at a different tax rate than your current income. So better for you in most situations. If you sell it within 1 year, you have what they call a short-term capital gain, which is taxed as current income, which is most of the time not good because it might bump you up into the marginal tax brackets. So be very careful in how you buy and sell. When we talk TSP and how TSP rolls into it, TSP basically holds mutual funds within itself. The C fund, F funds, S, C, and I, all those are all technically mutual funds if you look at it. They're an index mutual fund. How TSP makes money is through share price. They don't give actual dividends. You would love to see dividends because that'd make, like, government funds always give dividends in the outside world, or most of them do. You would expect to see that. However, TSP does not operate that way. It would be a really administrative nightmare for them to do it. So what they do is they do it by increase in share price. So they do a calculation, they throw it back into the price, and that's how you get share price with all the other stocks and bonds they hold in there. So TSP is all based on share price versus dividends. That's why if you happen to be a technician who goes on military orders for 5 years and then comes back to the technician world or the GS world and can get your TSP contributions back, like the matching contributions back, as long as you contribute to TSP when you're in the military, they can do it easily because it's all based on share price. It's not based on, there's no dividends that complicate the math. So in case you're wondering that one. Types of mutual funds. There are types and there's subtypes within those types. It really gets a little confusing, but I hope I can explain it well enough to you so that you understand what's going on there so you can make a right decision moving forward. Types of mutual funds, we start with overall, you have a sales loaded or a load fund or a no load fund. A sales loaded or load fund, I call them old school. This is my opinion. They charge you up front to buy into the mutual fund, or they charge you when you sell. So for example, I'm going to bring up my calculator here. I'm just going to show you an example, which I already have the example up there. So say you take $1,000. Oops, $1,000. And you want to invest it, and you go into a sales loaded fund that's going to take 6% of your money. So 6%. It's going to cost you $60 to buy that mutual fund. So now you're only investing $940. So instead of your $1,000 going to work in the stock market, you're only putting $940. That is sales loaded. Also called a commission. So sometimes they'll call that, hey, my commission's 6%. So they're charging you 6% to do the paperwork and submit the investment so you can go and buy it if you go to like a broker. The phase-out effect, what that means is the longer you hold a sales-loaded fund, the less money they're going to charge you on the backside if you sell. Some may charge you when you buy, some may charge you when you sell, some may do both. So phase-out is the longer you hold it, the less that back-end sales charge would be. And sometimes the longer you hold that fund, they might charge you less to buy to. But I call that old school because with the technology, the information, the education we have out there, I believe no load is the way you should go. TSP is a no load fund. They don't charge you anything to buy it. No load, there's so many options out there to do no load that they don't charge you to buy, they don't charge you to sell, with the one caveat if you're doing short-term trading. If you're buying a mutual fund and then trying to trade it within like a 90-day period, for example, they may charge you a back-end sales charge because you're creating them an administrative nightmare on that side. Mutual funds are not normally meant for short-term trading. You could do it if you wanted to, but that's why they sometimes they would charge you that, and they'll tell you up front they'll charge you that. So it's all in the paperwork. This is we're talking paperwork. When you go to buy a mutual fund, they will give you a prospectus. Every mutual fund out there has a prospectus. A prospectus is information in paper and electronic form that provides you everything to know about the fund. Fee structure, potentially who your fund manager is, and everything about what the objectives are of that mutual fund. So please make sure you're aware of the prospectus, because most of the time when you start investing, you have to click off that you have reviewed the prospectus, so that takes the risk off the investment company. Now we're back to, again, we have the two types. We have our sales loaded and our loaded. So if you look at a tree, you have a tree, you have your sales loaded, you load it up there. Now within both of those mutual funds, they're going to offer you a passively managed and an actively managed fund. We've kind of already talked about the passively managed funds. That's what TSP is. They match an index. So we're also going to call them index funds. So they match what the market index is. So for example, C fund in TSP matches the S&P 500. The 500 largest companies out there, that's the S&P 500, that's the C fund, index fund. And then there's an active fund, meaning that fund manager, instead of just allowing and matching the market, whatever the market index is, they're trying day to day to beat it. They're actively trying to beat it. I will tell you, as long as many other people will tell you, there is no one who can consistently beat the market over the long term. People have done it in good stretches, but on average, no one can consistently beat the market. Warren Buffett is probably the one exception. He's had bad years, don't get me wrong, but overall, he has outpaced the market just because he is just one of those talents, once-in-a-lifetime talents. There's some other people out there that have done well, like the person who manages the Yale Endowment Fund. They have beat the market as well, but they're rare to come across. So that's why, when it comes down to it, you always want to focus on the no load side because it's cheaper for you, more money, plus going to the market. And go to the index fund side, especially if you're looking for the fire and forget kind of side like the TSP. The mutual funds have those same options. Vanguard is the one who actually created the index fund, and I talked about them on the TSP one. John Bogle invented the index fund. If you're happy with what the market is doing, that's the index fund. If you don't like what the market and want to try to beat the market, that's where you go in the active. As long as you understand the risk involved, that on average, no one can consistently beat the market, because I want to say it's perfect. It's imperfect. It's just so much volume of trading, and it's timing. There's a lot to it, unless of course there's insider trading, and that's just illegal though. So overall, I will say index is the easiest way to go, and most of the time the cheapest way, because they charge less expense ratios. And we'll get to that here. So there's going to be fees. We'll talk about fees. The sales load we talked about, charging you up front and sometimes in the back. Redemption fee, which is, as I mentioned, the short-term trading fees. Sometimes you can get it from anywhere from 90 days to 3 years, but the prospectus will tell you all about it. There's a 12B1 fee, which is the marketing one. That's buried. Most of the time, you won't find that unless you read the prospectus. Maintenance fee is like a low balance fee. You will see that, and this is a great time to talk about balances and how to open a mutual fund. So once you've decided, like, hey, I want to open a mutual fund, you will most likely have to come up with a sizable investment, $1,000 to $3,000. There are some rules that some investment companies have that will allow you to start investing as long as you're doing an automatic deposit program. They may waive that initial deposit. So sometimes like it might cost you $1,000 to start a mutual fund or $3,000 to start a mutual fund, depending on the company. If you sign up and say, hey, I'll do $250 a month for the next X amount of months, they will waive that minimum deposit for you. Look into the investment company and what they offer. But mutual funds aren't as easy to get into. Like a stock, you can go put $100 in the stock market and buy something for $100. You'll have to pay a brokerage fee, but still $100. $100 won't start a mutual fund, but once you put the initial investment in, pending the automatic withdrawal option, you can then put $50, $100, whatever into the mutual fund after you start the initial deposit. So make sure you understand those. And maintenance fees, if you have a low balance, they'll charge you a fee. A lot of times the companies will waive those if you're doing the automatic program. Yeah, I don't see them as much anymore. Just make sure you're reviewing to see if there is a maintenance fee, because don't pay maintenance fees. That's money you're losing, right? And then the most expensive and the biggest, most important one, I say most expensive because of long-term perspective, is your operating expense or your expense ratio. We talked about these in the TSP. Remember when I showed you the slides, and at the bottom for each of the funds had an expense ratio? This is something you're going to pay. You may not pay a sales load, you may not pay a redemption fee, you may not pay a marketing fee, you may not pay a maintenance fee, but guess what? You're going to pay an operating expense ratio fee every year. This is how the fund manager makes money. They charge you an expense ratio. So the lower the better, right? And TSP was super low. Index funds will be lower than active funds because fund managers are not doing as much for the index fund because it's passive. When the index changes, they change. If nothing changes, they don't do anything. They're still doing stuff, but they don't do anything. Active people are trading day in, day out, trying to get ahead of the market, try to beat the market. It's going to be more expensive. Understanding those expense ratios are very important because a 1% difference can impact you long term. Think about if you had we're going to go basic math here. Basic math. Say you had $100,000 in an account, a mutual fund account, and they charge you 0.14% every year. Oh, I think I did that wrong. Let me just 1.4% divided by 100. I'm doing basic math because, hey, I make mistakes as well. There we go, 1.4%. And you're $100,000. So every year, they're charging you $1,400 to manage your account. You don't really see them pulling the $1,400. They do it in a way that how they balance out the price and the dividends and the capital gains, that you don't see them pull the $1,400. It's embedded within the fund. So that's $1,400 a year technically that you're spending on that fund, a 1.4%. So now we're going to go with a 1% difference. So we're going to go, okay, 0.4% is what they're going to charge you. So I'm going to divide by 100. Times that by the same $100,000. $400. So if you hold that mutual fund and say it doesn't grow, which it should, but it didn't grow at all. So for 30 years, with this 0.4%, you have paid $12,000 in fees. With that same one at 1.4 times 30 years, 42,000. What was it? $12,000. You have spent $30,000 when you didn't have to. The lower the fee, the better. Just a quick example. 0.4 honestly is an expensive ratio when you look at TSP. TSP was 0.0 something. You will find the index funds offered by, for example, Vanguard, 0.0 something. Really cheap to own. And index funds, fire and forget weapon because they match the market. I'm not telling you to go out and invest in an index fund. I'm saying that look at the math and look at the simplicity, make your own decisions with the resources provided here to see, is index fund something you want to pursue, or do you want to try to beat the market? That is your call. Understanding the risks as well. How mutual funds can differ. Oh man, strategy, style, objective. The TSP world does the target age dated ones. That is their strategy. Like, okay, we're going to start you off aggressive if you have a long term to go, and we're going to modify it along the way so that when you hit retirement age, it's very conservative. We looked at that yesterday. And if you didn't watch yesterday's, I highly recommend you go out there and watch it, because we show you tsp.gov itself and how these funds change over time. It's very good to understand how these target aged, retirement aged, the L funds kind of work as a strategy. Their style, you want a growth one, you want a value one, you have a blend between the two. Do you want a bond one? What style are you looking for? What kind of asset allocation are you looking for? And then there's the objective. Do you want to make it, hey, I want a super growth, I'll be very aggressive. Do you want to preserve your money? Do you want to get dividends? What is the objective? And the prospectus will tell you all about this. And also the mutual fund companies will have a nice tool inside their websites to help you come to these decisions on what you should invest in, or recommend mutual funds to invest in based upon the objectives, the strategy, the style you're looking for. I will say there's a mutual fund for basically anything you can think of out there. If you want to do precious metals, it's out there. If you want to do socially conscious, if you want to do like companies who are very socially conscious in their investments, they are only green, maybe they're vegan, something like that, you can find it out there. I will say most likely those will be more expensive to manage because you're looking at an active fund, but it's out there. You can find what you're looking for with different fund screeners, and I'll get to this, or even using AI or just Googling the information, you can find something. But it all comes down to risk tolerance, making sure you understand each mutual fund will have a certain risk level attached to it. Precious metals are more of the higher risk. Socially conscious might be higher risk as well, depending on it, or could be pretty stable. It all depends on who they hold. Municipal bonds, for example, probably very low risk, because those are offered by the state and local governments as like revenue projects, like for example, a road. They take out a municipal bond for a road, pretty low risk. What you're looking for is out there, but you need to understand your risk tolerance and what you're willing to potentially lose or gain. You got to understand that it's on the other side as well. Finding your mutual fund. I kind of mentioned this before just when I talk about fund screeners. There's a few ways you can do it. A broker is always available to you. Some broker firms out there that you might have seen in your local area: Edward Jones, Merrill Lynch, First Command, even State Farm technically is a broker, because you can buy mutual funds through State Farm. Insurance companies sometimes have that ability to offer mutual funds, and they're brokers. Basically, again, brokers are buying it for you, so they're going to charge you a loaded fund. It's going to be a loaded fund. So they might take a 6% commission because they're giving you advice on what you should invest in. But also make sure you look at the credentials of this broker. Are they even licensed to offer you advice? Like me, I'm not licensed to provide you investment advice directly. I can recommend overall things to you, show you where resources are, provide you education, but I'm not going to tell you go invest in this company or do this mutual fund. Brokers will try to do that, but make sure you look at their credentials, because they're not always going to offer you things in your best interest, because it is commission based. They're probably going to look for the largest commission. And they get compensated whether you make money or not, because they're making money off you when you buy the fund. It's all about fiduciary responsibility. I'm going to skip to the bottom here and talk about certified financial planners. I have talked about them before. They can be expensive because they're certified. I gave you a web link there for you to go find a certified financial planner if you're looking to go down that route. I would look for fee-based only, meaning I'm going to charge you $100 an hour for your advice. Sometimes it could be $200 an hour, depending on their credentials and how much they charge, where they're located, such and such and such. But what you're paying for is expertise, because they have to take classes. They have to do so many hours of experience underneath a CFP, and they have to take a very hard test. I've taken all 6 classes. I can tell you they're not easy classes to do. A lot of studying to do to pass the tests just to get to pass the class. And then you got to pass a big test. I haven't done it yet. Not sure I want to do it, depending on my future, what I want to do in retirement. But look for them. I recommend them because of their fiduciary responsibility. President Obama really is the one who kind of made sure our fiduciary responsibility was built into these people. They must do what's in the best interest of you. They are certified. They must take an ethics oath and everything. Otherwise, their certification and their ability to do business is put at risk. If they do something that's not in your best interest, you can technically sue them and get your money back. CFPs can tell you where to invest. They can say, based upon what I'm seeing, I recommend the following funds to you. And of course, you need to choose, but they will help you make that decision. That's what you're paying them for. You're paying for expertise. I'm not saying go rush out and do that, but if you're looking for someone to really provide you guidance and look out for your best interests, you're looking for a CFP. And I would like to say always independent of an investment company, because they're independent, so they're not going to push what's going to make them money. Even though it's a good account, a good mutual fund, they may still kind of push something that's in the gray area of fiduciary responsibility. But then you can do it yourself. With today's day and age, what you all have today is not what I had back when I was young. All these fund screeners or even investment company websites, AI, for example, can do some great things for you. Yahoo Finance has a fund screener. Morningstar.com has a fund screener. They have a star rating 1 through 5 that can help you. If you go to companies like Vanguard, Fidelity, T. Rowe Price, Charles Schwab, etc., their websites, they have great tools that can help you choose. And just because you go to Vanguard doesn't mean they're going to not include Fidelity or other people's mutual funds. You can click buttons to say, I want Vanguard only, or I want all. Look at all. You could buy other companies through Vanguard, just cost you a little bit more maybe to do it, but they understand they're not the only, person who's offering these funds. So if a tool is good, it's open to everyone. There's a forum called Bogleheads. It is based upon Vanguard's principles, because remember I said John Bogle, CEO of Vanguard, is the one who created passive investing. Index funds was his creation back in the 70s, I believe. It's just a forum. They talk about different things about index investing. Good thing to join. More information. Knowledge is power. Or you can use AI. Go into Gemini and say, hey, I'm looking for this type of mutual fund. My objective is this. Any recommendations? But trust but verify. Just because AI says it doesn't make it true. Go ahead, do your research. And I do recommend looking at different companies and what is best for you. Those companies I mentioned, they're just some of the larger companies out there. They all have different fees. They all have different minimum balance requirements. They all mostly already offer automatic investment, those automatic investment monthly plans. But when it comes to fees is kings. You want the cheapest fee possible, right? How I would rank each one of these companies based on fees. Vanguard, I would say, is the cheapest overall. They offer index and they offer active. They're pretty cheap overall, expense ratio wise. Then I would say Charles Schwab. Then I would say Fidelity. Then I would say T. Rowe Price. But there's other companies out there that you can invest with. I'm not saying those are just for that I have personal experience with that are highly rated and ethical companies. In the 1990s, when the mutual fund world was just going crazy, a lot of companies got into trouble. Vanguard was one of the companies that, when Congress was doing all the investigations, they were one of the ones they looked for to provide professional advice from the good side. Fidelity is a great company as well. T. Rowe Price has been there a long time. Charles Schwab, you see all the commercials. They're a good company as well. Do your research. Not telling you to choose those, but I'm telling you to do your research, because all of them will offer good investments. But then you got to look a step deeper. Does it meet my objective? Is there a minimum balance requirement? Do I have a minimum balance I got to put in to start the initial investment wise? What are the fees that are going to charge me? And there's good calculators out there you can find on like dinkytown.net that you can go there and do a calculator to do fee calculator. What's the difference between a T. Rowe Price fund versus a Vanguard fund and see if they did exactly the same. If they're an index fund, they should be doing exactly the same. What's the difference? How much will that fund cost me if it has a greater expense ratio? Because an index fund, if they're all matching the S&P 500, shouldn't the expense ratios be all the same? But that's when you go into the marketing that might be a little more expensive because they're doing a little bit more marketing from their perspective. That's where they might have a different expense ratio. You see a lot of commercial for Charles Schwab lately. I see Fidelity, I see Vanguard. I haven't seen any T. Rowe Price commercials for a while. Special note, ETFs, exchange traded funds. Just want to explain these real quick because they're very similar in the mutual fund realm. And when you're talking mutual funds, you really got to talk ETFs almost now. An ETF is a basket of securities like a mutual fund, but it acts like a stock. So you can trade it multiple times a day. So you can, in essence, be day traded. It goes up and down all day long and has different prices all day long. You can buy it and sell it all day long, but it kind of acts like a mutual fund because you're holding multiple companies within that one share of an ETF. So buying one share in an ETF, you're buying multiple companies like a mutual fund, but it acts like a stock. They do offer low expense ratios, but you also have to potentially do a brokerage commission because you're buying it from a stock market exchange. If you're looking for something a little more aggressive, those might be up your alley. If you don't like the mutual funds, the index fund, but you still want to do the principles of diversification, ETFs might be the way to go. I'm just putting it out there for knowledge base. And they're not also insured. So I want to make sure I have that point. Mutual funds and ETFs are not FDIC or NCUA insured. However, your brokerage firm, if they go belly up, you could be insured for some money. We just covered mutual funds and what they are. I know there's a lot of information we covered on mutual funds because this will set a basis for one, TSP. So hopefully you understand TSP a little bit more because all TSP offers, those are really mutual funds. The C fund is a mutual fund matching the S&P 500. All the life cycle funds are all the different funds, the C, S, I, G, F in different ratios, all mutual funds within the life cycle funds in different ratios. So life cycle is basically a mutual fund of a mutual fund. That sets the basis most of the time for an individual retirement account, an IRA. This is just another way you can save for your retirement. Besides TSP, you have an individual retirement account. But how they differ is TSP or 401ks are linked to your employer. They're offered by your employer. Once you leave that employer, you no longer can contribute to that account. You can move it with you to your next job, but it's employer related. An individual retirement account, an IRA, is linked to your Social Security number. So it moves with you. You can have both TSP and an IRA. IRAs, though, have some income restrictions, and we'll get to that. TSP does not have an income restriction. IRA does. Except for, I think TSP, if you're like SES wise, I think there is an income restriction, but that's for the SES level. IRAs have an income restriction. Two options, just like TSP, traditional, tax deferred, meaning you don't pay taxes now, you pay them in the end when you withdraw. Roth IRA, you pay taxes now, but you never pay them again. Within an IRA, though, you can hold more than a mutual fund. You can hold individual stocks. You can hold ETFs. You can hold gold itself, bonds. Just note you won't get the gold in your possession. They'll just hold the gold for you at some central depository. Shipping fees, you know. Traditional IRAs, just like traditional TSP, tax deferred. How the rules apply for IRAs is you're able to withdraw at 59.5 penalty free. There is no clause about the whole 55 retiring from your current employer like TSP has. IRAs don't have that. It's normally 59.5. There are some other rules, but we're only going to get into the majority of the rules. If you withdraw it before 59.5, you'll be subject to a 10% federal tax penalty. And remember, tax deferred means you never pay taxes on it. So if you take it before 59 and a half, one, you're going to pay taxes on your withdrawal because you never paid taxes to begin with, and you get a penalty because they don't want you to touch it until you're retired. Structured, as we talked about before, they have a required mandatory distribution date, as we talked about in the TSP, and that's only for the traditional side. Your RMD is 73 years old, so you must start taking distributions from your IRA by 73, and that's going to change as we get a little bit older. That may adjust based on your birth year. If you don't start taking distributions by 73, the government will start sending you the money, and they'll do the math. So what they do, 73, say your lifespan is 80, so you have 7 years divided by your balance, boom, that's what you're getting per year. So they're going to do it for you, and that could have tax implications because that's maybe not how you wanted to do it. So make sure you do the minimum mandatory distribution or take more as you want starting at 73. For a traditional IRA, and these limits will be very similar in the Roth side, you can only do a max contribution of $7,500 a year for 2026. This changes sometimes every year, if not every 2 years. And of earned income, I do underline and I bold that for a reason. If you remember my pension brief, when I talk about, hey, in retirement, if you want to contribute to a IRA, you must have earned income. A pension is not considered earned income. It's by tax law classified as unearned income. So if you want to contribute to an IRA once you retire from the military or the federal government, you must have earned income. So you must have a job elsewhere providing earned income to contribute. If you're over age 50, there's a catch-up contribution of $1,100. Again, that changes every year, every other year. So just making sure you understand the rules there. Once you get past your RMD with a traditional IRA, 73 in this case, you can't contribute anymore. You're pretty much done because you're in the withdrawal mode, not the contribution mode. You can have more than one IRA if you wanted to, but per social, you can't exceed the annual limit. So if I had an account at Vanguard, Fidelity, T. Rowe Price, and Charles Schwab, cool, I have 4 accounts, but within those 4 accounts, I cannot exceed $7,500 per year. So remember those limits. Tax deferred growth, we talked about that. You have a wide range of investments, and you might be able to take a deduction on your taxes. That's how it becomes tax deferred, because you reduce it off your taxes. But there is income restrictions. To take the full deduction, you have to make 149 or less, married filing jointly. And their single is 91,000 or less. If you make above that, you can still take a contribution, but it won't be full. And there's eventually it will get to a point that you can't take it at all. So there's income restrictions in traditional IRA that could potentially reduce what you're able to have. Tis what it is. That's meant there. I don't know why they did income limits, but I guess for rich people, if they're considering 149 rich, that's not rich by any means, especially in the NCR. So make sure you know the fine details. Roth IRAs and started in 97, tax-free, meaning you pay into your Roth with your after tax or with your checkbook money, with your net money. You get paid, it gets taxed, it gets deposited into your checking account. You then invest in the mutual fund. You've paid all taxes already. You'll never pay them again. Versus tax deferred, you're technically not paying taxes on them up front. You pay them in the end. A little rule about an IRA is you must have one open for 5 years to start withdrawing from it. So you have to make sure you've owned it for at least 5 years before you start withdrawing from it. You can hold a bunch of different things within their IRA besides mutual funds, but there's no required mandatory distribution date. So as long as you have earned income, you can keep on contributing to your Roth IRA till the day you die, and you don't have to take anything out of the Roth IRA. So it could pass to your heirs tax-free if you wanted to. Remember, they're not tax deductible because you pay taxes up front, but you never pay them again. You can have more than one IRA, but just remember it's all per social. You can't exceed that amount per year. A question that came up is, what about joint IRAs? Well, the term joint IRA doesn't really exist. You could have a joint account with your spouse. However, IRAs are linked to your social and your social only. So you'll have your contributions and your accounts and your earnings attached to your social, and your spouse will have to their social. They could be a joint account, but they are separate within the joint account on the backside. So that investment company would know exactly what you've put in and what you've earned and what your spouse has put in and spouse earned. That's how it works. It's per social. It's still $7,500 per year for Roth. They'll probably traditional and Roth will go the same way. The limits will be the same, and the catch-up contribution will be the same. So just make sure you understand it will grow each year. Since there's no RMD, you can keep on contributing, again, as long as you have earned income. I want to talk about income restrictions for Roth because it's a little more complicated. The modified adjusted gross income. If you all had your tax returns in front of you, most people probably never look at the physical copy of it. You might look electronically, but most people don't even look at it, period. Make sure you keep them for at least 6 years, though. And HR Block does keep them in a database for you, because I know I say HR Block because it's free for us. Why not use it for free? Free, right? Free. Military One Source, HR Block for free. If you look at your front page of your 1040, you have all your income, you have all your interest, and then you're allowed to take certain deductions, like student loan deduction, maybe a teacher deduction, and then a math problem happens, and then you come up with this term called modified adjusted gross income. So really that is just your income minus a few minor deductions to get you to the modified adjusted gross income. So if you're married filing jointly, if you earn less than $242,000 combined, you can make a full contribution. If you're in between 242 and 252, you have a reduced contribution, and 252 above, nothing. Understanding BAH and BAS do not count in this calculation. This is just what you're being taxed on, but also understand if for some reason you make a contribution when you should not have been able to make a contribution, the IRS will eventually find out, and your investment company may find out as well. And what will happen is they will send you a nastygram letter or email saying you have contributed to a Roth IRA when you're not authorized to. You must withdraw your excess contributions, and depending on the tax year in which you made the contribution to what the date is now, you might have to pay a penalty. So they do it pretty hard that you're not supposed to have it. There are calculations if you're in that middle, like the 242 to 252 range for married filing jointly. There is a mathematical formula to determine how much you can contribute. If for some reason you figure out, hey, like for example me, last year, I hit that limit with my wife's income. I'm like, holy crap, I didn't realize it. So I figured it out, took my excess contribution within the same taxable year, and I did not have to pay a penalty. I had to do a whole bunch of stuff on my taxes for it, but it was a pain in the butt. But if you catch it soon enough, you don't have to worry about paying any penalties. So make sure you understand your income and how that impacts your IRA contributions. Some special notes. You do have the ability to access your IRAs for certain reasons. You can do it for, they call them qualified expenses. So for example, buying your first home, you might be able to access money from your IRA penalty-free. College, penalty-free. I say penalty-free for a reason. Traditional IRAs, remember, you never paid taxes on that money. So if you withdraw money, for example, for a first home, $10,000 before age 59 and a half, you will have to pay taxes on that $10,000 because you never did. But you can get it penalty-free. You don't have to pay that 10% penalty, but you will have to pay taxes. Just remember that. For a Roth IRA, it doesn't really work that way because you already paid taxes on it, remember? You can always get your contribution back at any time. Because you've already paid taxes on it, you could always access your contributions, but the earnings must stay in the Roth IRA. So you can pull back contributions, but keep the earnings. If you're looking at doing this, which I have done it, I didn't want to do it but I had to do it for a certain reason. Take good notes, because you really need to ensure your tax return is correct, that your contributions make sense, because the IRS will find out and they will send you a nastygram. They sent me a nastygram. I thought I did it correct at the time. I did not do it correct. I had to back file, had to send them proof of contributions. I had to correct it later. It was a nightmare. So if you're in that situation that you have to do this, please look at the tax law. Please ask the right questions on how you should do it. Gemini really can do a great job in telling you what you should do. I can help you if need be, and I can tell you what I did, but it does get a little complicated. So really try not to do it, but if you have to, make sure you have good notes and you have good documents all in line to prove that you pulled your contributions out, not earnings. Just want a side note, this kind of goes with the TSP loans. I don't want you really to do it, but if you have to, the option's there. Bonus round here. What about my spouse? My spouse isn't working right now. Can they have a Roth IRA? They're not earning any money. Can they have a Roth IRA or an IRA? The answer is yes. There's a spousal exemption out there. The rules of Roth IRAs and IRAs in general is earned income. We've already talked about that. In order to put $7,500 into an IRA in 2026, you must make $7,500 minimum of earned income each year. So in 2026, if you make $7,500 in income, you can put $7,500 in an IRA. Earned income, that's how it works. If you make $5,000 because you're in retirement, right? You're kicking back, you're relaxing, but you're only making $5,000 a year. You can only put $5,000 into an IRA. That's how it works. How a spousal IRA works is if you are, I hate the term, use the term breadwinner in the family, you're the one working, you make at least $15,000 of earned income in 2026, you can have an IRA and your spouse can have an IRA. That's the way it works. Spousal exemption. If you make $20,000 or if you make $100,000 a year in a earned income, you still can only do 7,500 and 7,500. So understanding the max, but also understanding the min. And that's where it comes into mins. I've set up a Roth IRA for my child. They're 6 years old. Boom. You really can't legally do that. Does your 6-year-old have earned income? Is your 6-year-old filing a tax return? Because the IRS will eventually find out and say, whoa, time out. What are you doing? Allowance technically is not earned income. I guess you could try it and file a tax return and file it as earned income, because there's a way you can do other income on a tax return. If you're going to go down that route, you better do all your tax returns and cover your butt. So I would say don't do it. But if you want to do all the tax forms, there's a possibility you can do it. But if your child actually earns income, if your child is a child actor, child model, or child whatever, and they're making earned income and have the taxable forms, you can open a Roth IRA for them. Like all those kids that you see acting, if they're making money, as long as they are under the income threshold to have an IRA, they could put money into an IRA. It's cool, isn't it? So really, that's all I have. I will talk about a few things when we kind of wrap up this. But let me rack and stack some things for you. I know I threw a lot at you. This was a lot about mutual funds, but you can take this and listen to it again. You can read up on things. There's a lot of good information about mutual funds out there. I used to be what they call a chartered mutual fund counselor. I let it lapse because I was getting hard to do that and keep the accreditation up and work full-time in the military. So I let it lapse, and sure enough, guess what? It's no longer a thing. So I learned a lot about mutual funds. It was my area of expertise. There's a lot of good information out there. A lot of good authors talk about mutual funds. You'll see most of them kind of direct you toward the index funds, because really, again, it comes down to no one can consistently beat the market unless you're named Warren Buffett. So index investing is really a good way to do it. What I'm going to do now is talk about rank and file and order of the last few days. I'm going to walk you through what you should be thinking about through your career. I know most of the people on this and listen to it are more senior in their career. Right? I'm not talking to a lot of airmen out there, but it'd be great to actually get this to the airman level. Or your dependents. What I want you to think about is rack and stack priority savings. I'm going to give you two options. I'm going to give you a very simple one, but then I'm going to give you a more complex one. So how we start with saving preferences is you want to start with your emergency fund first, but at the same time, do your matching contributions to your 401k or TSP. Never give up free money. So if you're a FERS employee or you're a BRS member, military member, I know the BRS does have that staggered matching contributions, but understand if you're getting free money, you should always take advantage of that free money. So as you're building up your 3 to 6 months of living expenses, and if you don't know what emergency funds are, and this is like, what are you talking about? Please watch Basic Savings Part 1. Talk all about emergency funds in detail. 3 to 6 months of living expenses in there based upon how stable your life is. It's used for transition. It's used for emergency expenses, like a furnace blows up or something. But that 3 to 6 months of living expenses is meant to help you transition between jobs. In the government, we're kind of more secure from that perspective. If you're in the private sector, you might lean towards more 6 months to make sure you're all good, paying your mortgage, paying your rent, buying groceries, all that stuff, so you can eat until you find a new job. Emergency fund in tandem with your matching contributions to your TSP and your 401k. Always get the free money in tandem with the emergency fund. Once you've hit your emergency fund limit, now try to max out your 401k, because honestly, sometimes they're the most simplified way to save for your retirement. They also, like, for example, the federal government is very cheap when it comes to owning TSP. It is a great thing to do for TSP. It's very cheap to own. There's federal oversight on it. You can put a lot into it, and there's no income restrictions. If you don't want to do that, for example, if you want to do on your own, you can always go into the IRA mode and do something a little bit different with mutual funds. However, remember, there is a mutual fund option in TSP, but it's a little more expensive versus doing it yourself. So rack and stack, emergency fund in tandem with matching contributions. Put the min in to get the max out. Put your minimum of 5% in, for example, for the government, to get your max 5% out in tandem with the emergency fund. Once emergency fund is all set, either increase your TSP allocation or start doing your IRA. I do say, though, caveat, buying your first home. If you're in an area that you want to kind of settle down, Air National Guard, we may never leave our area. If you're here on a STAT tour or a ADOS tour and you potentially want to go back to your state and stay there for the rest of your life, we might want to buy a home. When that comes into priority-wise, you have to kind of ping this against your Roth IRA or your traditional IRA. You're definitely doing your emergency fund because that's mandatory. You got to have that security on your side, hopefully in a high yield savings account. Again, if you're not getting a high yield number, refer to Basic Savings and figure out how to get a high yield savings account paying you more, still insured, still safe, but more interest. Doing your tandem 401k, getting your matching contributions, then start saving for your down payment. If you're military, we have the VA benefits. You don't have to put anything down, although you'll have to pay a higher funding fee, but you don't have to pay a down payment down. If you're not in that realm, you might have to come up with 20% for a down payment on a home. You need to start saving for that down payment so you don't have to pay private mortgage insurance, PMI. It gets expensive over the time. So again, balance that with your IRA. Once you have your down payment or you have your home, start trying to do an IRA if you can max out your TSP. Again, you can also go between TSP and your IRA, half and half, or whatever you want to do if you want to get a little more aggressive or want to diversify your holdings within IRAs. But always put them in to get the max. And then once you're able to max out everything, then you can look at personal investing. There's nothing tax beneficial to that, but you can put money into the market or into other cash equivalents to start saving money for other greater goods. Well, what I want you also to think about is, if you're starting from scratch, is starting with that budget, making sure you're not spending more than you have, living within your means, because that sets you up for no debt. If you find yourself in debt, review debt management. So we have a surplus in our budget because we did good with budgeting. We're living within our means. As we get promotions, we're saving that excess. As we do this, we're building our emergency fund. We're doing our TSP in tandem to get the matching contributions. We're getting all that free money. We're deciding, are we focusing on a down payment for the home, or are we going to be a renter for the rest of our lives? Figuring that out. I'm doing my IRA. Can I max that out? Boom. Can I do personal investing? But all amongst this whole life, you have to remain flexible and live your life. Don't put yourself into a box. You have to be flexible enough in your budget to grow. Kids are on the way. You're getting married. Oh, for some reason, a divorce happens. You have to be flexible enough within your budget to adapt and overcome. Plan of operations all goes back to time, consistency, and growth. That's part one, basic savings. One thing, I know I'm going a little long on this discussion, but I want to talk about plans of operation, time, consistency, and growth. We in the military have the opportunity to retire early. For example, I'm 47 and a half years old when I hit my retirement date. As we talked about IRAs, I can't technically touch that legally, penalty free, until 59 and a half. I have a 12-year gap I have to overcome. Because I understood my PCARs, because I understood my pension, I knew I had to do a plan of operation, an ops plan. Time, consistency, growth. I knew I had 12 years. I knew this a few years ago. So what I did is okay, I need to start saving for these 12 years. My pension is great. Whatever my disability rating is going to be, that's going to be cool. But I have money in my Roth IRA out there in my TSP that I can't touch. I need to build a stockpile of cash so that I can have some fun money over this next 12 years to just be there just in case. So I had that ops plan in place. So I started saving for that to get the chunk of change. I want just to make sure you all understand your time, consistency, and growth. Understand your plan of attack. Understand what's available to you. Get the resources ahead of you. Understand, ask questions, educate yourself, pay it forward, and live your life. This is my last briefing. I turn on my computer tomorrow. For the last time, I'm available to you. You have my email address. You have my cell phone. I will not charge you ever. I'm here to help you all. Pay it forward. And for the last time, Colonel Domchowski, out.